P11.12. Kershaw Electric Limited sold £6 million, 10% 15-year bonds on January 1st, 2020. The bonds were dated on January 1st, 2020 and paid interest on January 1st. The bonds were sold in 98. Instructions. Prepare the journal entry to record the issuance of the bonds on January 1st, 2020. Well, just like I said before, every time we record issuance of the bonds, we are selling the bonds, right? So we are getting cash from selling this bond. So our cash has to go up and our bonds payable also go up. Since it's a bonds payable, this is a liability, right? Which means that the increases happen on the credit side. That's why the position is like this. And this number over here is always going to be the issuance price, the present value. This is not the issuance price, right? We have to calculate the issuance price because here they said that they were sold at 98. So what we're going to do is we're going to have the original value times, every time you see a number like this, just pretend that this is 98%. So you have to divide by 100, right? So that is 0.98. So you can multiply it by 0.98. That gives us 5,880,000, and this is our issuance price, our present value. B. At December 31st, 2020, the amount of amortized bond discount is £8,000. Show the statement of financial position presentation of the bond liability at December 31st, 2020. Well, in order for us to understand this exercise a little bit better, I'm going to use a table that we normally use when we are calculating bond discount or bond premium, right? The discount amortization or the premium amortization. I'm sure that you have seen this table before. Here they didn't ask for us to calculate this 8,000. They already gave us the value of 8,000, but I want to use this table in order to show you where is this number and where is it actually coming from. So over here, we know that it's a discount, right? Because here they said this bond discount. So over here we would have discount amortization. And we also know that because of the issuance price, right? Because the issuance price is smaller than the face value. So this is definitely discount bond. Then over here we would have book value of the bonds payable. They were issued on January 1st of 2020. Here I'm going to put December 31st of 2020. And here I'm going to put January 1st of 2021. Okay. That's all we need for now. So since this is the issuance date, the book value of that date is going to be this, right? Because at that point, nothing has happened yet. No interest has been accrued. Cash interest, remember that I told you that it starts with a C, right? So this percentage is the contract value percentage, right? So over here, that is 10%. Our interest expense, normally this percentage comes from the market percent. But if you take a look over here, we just have one percentage, right? We just have the 10%. Well, actually, for this exercise, we don't actually need to know this. What we do need to know is this and this. So the cash interest is the one that doesn't change. So we calculated by having, it would start here, right? By having the face value times the contract rate. And that would give us 600,000 for all of the remaining years, right? This number would not change. This number would change, but since we don't have the percentage, we're not going to calculate it because there is no way for us to calculate it. But over here, they tell us that the bond discount is 8,000, right? What they're saying is that on December 31st of 2020, this is supposed to be 2020, of 2020, over here, they have 8,000, right? They have 8,000. And if you remember, every time we are making this table, there are two types of table that we can make. We can make the discount amortization table and we can make the premium amortization table. Remember that I told you that this column over here is counterintuitive. What does that mean? If this is a discount amortization table, here we would be adding it. If this was a premium amortization here we would be subtracting it. Since this is a discount amortization table, we would be adding. So over here, we would have to add this value plus the discount amortization. That would give us 5,888,000, right? This is the first thing that you need to know. So over here, they are asking us to make a statement of a financial position. Two things. Remember that when they ask us to calculate, for example, discount amortization or premium amortization, we make an entry here, right? Normally the entry that we make is what? It is interest payable, which is the interest that does not change. So it is this value over here. Then we would have interest expense on top. And we would have bonds payable, right? In this case, the position would be over here. How do we know this bonds payable position? Well, like I said, bonds payable, it's a liability. It's actually a non-current liability. All liabilities, the increases happen on the credit side and the decreases happen on the debit side. So in this position, it's on the credit position, it's going up, right? And indeed, it's going up, right? Because we're adding numbers. So that's why, and that's how you know the position. So in theory, the entry that we would make would be 600,000 because the interest payable does not change, is the amount that would be payable every year according to the contract. The bonds payable, they told us that that is 8,000 and the total value would be 606, right? Yeah. Over here, they are asking us to show the statement of financial position of the bond liability at December 31st, 2020. So what they want to know is how much would my bond be worth at December 31st, 2020? Well, how much is worth? That is book value, right? And at December 31st of 2020, this is the book value. So this is where this number comes from. So over here, let's make a statement of financial position. You're already familiar with how statements work. You always have to put the name of the company at the top, followed by what kind of report that is. In this case, it is a statement of financial position. But it could be, I don't know, a balance sheet or cash flow statement. But in this case, it is a statement of financial position and the date. And then bonds payable, it is a liability, right? So it has to be under the liability section. In this case, it is actually a non-current liability. So we're going to write that under non-current liabilities. Okay? And then we have bonds payable. And the amount would be 5,888,000 because we added the previous 8,000 from the discount amortization. Okay, see. On January 1st, 2022, when the carrying book value was 5,896,000, the company redeemed the bonds at 102. Record the redemption of the bonds, assuming that the interest for the period has already been paid. Okay, so we are under here, right? So I'm going to bring all of this down. Okay. So we are at January 1st of 2022, and they said that the carrying book value of the bonds, it is 5,898,000. Okay. All right. So they redeemed the bonds at 108. So what was the value that was original written on the contract? It was this, right? But they bought it now for 102. So we have to see how much they actually paid. So this is going to be the original value of the contract times, remember, we divide by 100, so it becomes 1.02. That gives us 6,120,000. This is the current market price. It is the price that they paid, right? You paid this. But they said that the current book value was only this, correct? So you paid more than it was worth. So there is a loss, right? Because if you paid less than what it was worth, then it would be a gain. But you actually paid more than the book value, the current book value. So we are actually going to have a loss. So over here, we're going to journalize it. First things first, when you buy something, over here they said that the bonds were redeemed. So the company spent money in order to buy the bonds back. So you buy something, your cash has to go down. That's the first thing. Second thing, bonds payable is debited, right? Because again, like I said, liabilities minus and plus, right? Originally, I had these bonds that had to be paid in the future. I had these things that I had to pay. But now I bought them back, so I no longer have the same amount to be paid. That's why we have to reduce it. That's why it is debited. And we are going to have a loss, right? So this account is called loss on bond redemption. And like we saw in the previous chapter, every time you have a loss and a gain, for example, when you are disposing, remember last chapter we studied selling equipment or disposing equipment, scrapping equipment, we have a loss on disposal. Now we have loss on bond redemption or gain on bond redemption. So this account is counterintuitive, right? So the loss here is a plus and here is a minus, and the gain here is a minus and here is a plus. So we are debiting it because we are acknowledging that this loss is going up. We are saying that we have a loss right now. That's why we have on the debit side. Okay, so how much is your loss? Well, this is simply going to be the amount that you paid minus your book value of 5,896,000. That is 224. And the bonds payable, that would be the amount that was the original current book value. Let me put this over here. Okay, and the total amount, because that's the amount that you actually paid in cash to buy back these bonds, right?